Welcome everybody to the webinar this afternoon or morning if that's where you are. We're going to give it just a couple more minutes and allow some more people to log in. I see there are people logging in, and then we will get started. So just a couple minutes, hang tight. Okay, I think that's enough time. Anybody who's not here can catch up with us. Once again, I want to welcome you to this webinar. I've been excited to do this because I really believe that this can be a great value add for your business. It can help your clients, it can help your business, and it can also create a new revenue stream for you. And so I kind of want to go over cost segregation. Some of you may be very familiar with cost segregation, but not sure exactly how you can use that yourself to make your business that much better for your clients. And I want to go through that a little bit and how it can benefit both your clients and your practice as well. If you have any questions, I'm going to save a little bit of time, hopefully at the end, for some questions. But if you have any burning questions that come up, please feel free to use the chat box. You can chat them over to me. Should we run out of time, I will definitely answer any questions that are asked by email later. So the idea of cost segregation has some complex compliance issues for building owners and also some huge economic benefit. So who can benefit from a cost segregation study? Any owner of a recently purchased or built building, and even owners who've owned a building for several years. I'm going to say any building that's been bought or built for over the last, say, 10 to 12 years, that has a value over $200,000 is a good candidate for cost segregation. Also can benefit an owner or a tenant who's paid for past improvements or repairs. Even leasehold improvements can be handled under a cost segregation study. Cost segregation is a wonderful tool for estate planning and trusts. That's a whole different webinar. And it's also good for triple net lease tenants and owners. The biggest beneficiaries are going to be your landlords and your multi-property owners who own apartments or condos, hotels, self-storage, warehouses, nursing homes, assisted living, and you can read that. I don't need to go through all of that for you, but I can tell you that I just recently helped a building owner who owned a warehouse get an additional $2.3 million worth of tax deductions from their taxes just by doing a cost segregation study. And the cost was ridiculously low for the study and was of tremendous benefit to him. So what are the opportunities for you? Basically, I said in the introduction of this that this was going to take you no work and you wouldn't have to spend any money or any time. All you really need to do is introduce CSSI and introduce me, and I'll take care of all the details. It'll reduce the building owner's taxable income. It'll maximize their expense deductions by accelerating their depreciation. We're going to get into a little bit more of the weeds of that as we go along. And they can use the time value of money to their advantage. It's going to generate some serious cash flow. My business is Cash Flow Strategies. I'm the CEO and founder of Cash Flow Strategies, but I'm also a national account executive with CSSI, Cost Segregation Services Incorporated, because I believe that's one of the best ways for a business to increase their cash flow. So they can use that cash flow to purchase other buildings, hopefully from you. They can make improvements, they can renovate, make repairs, all those kinds of things. We can help them generate the cash flow in order to do that. So what's the benefit to a real estate broker? What's the benefit to their clients? Well, this can be looked at as a value-added service that you provide for your clients and giving you a happier client. The client retains the money that would have been paid for income taxes in the very first year that we do the study. They have more cash available for closing their deal, working capital to buy more buildings, pay for improvements. You get it. Cash flows increased in the earlier and riskier years of business ownership. So early on, we're going to make it easier for them to survive those rocky first years of business, if they're a new business owner especially. So what does it mean to you? Well, this can create another revenue stream for you by adding value or cash flow to your clients. It gives you another reason for you to be their trusted advisor. And we all know being a trusted advisor is much better than being a salesperson. If people know they can trust you and they like you, they're going to do business with you. And so it expands the value proposition in your business activity. It differentiates you from the competition. Not a lot of commercial real estate brokers will mention cost segregation as something for the owner, and many of the owners are not even aware that it exists. You can bundle cost segregation as a part of your overall services, and it frees up more cash flow for your clients to invest. It provides lower income taxes for them. My suggestion is go back, take some time this weekend, next week, go back at some past clients who purchased buildings, and I'll tell you how to give me just a few pieces of information on that building, and we can create a free, no obligation preliminary analysis of their building to show them what the potential benefit and the actual cost would be of doing a study, and then they can make up their mind. Give me a couple of ideas what this can do. If you were to refer me 3 buildings a month, let's say a $1 million office building, a $5 million self-storage building, and a $10 million medical building. These are just estimated contract fees to the client, but if the client's contract fee was $5,500, I will pay you 10% of that, or $550. On a $10,000, that's $1,000. On the $12,000, it's $1,200. And in the month, by referring 3 people to me, you can make $2,750. 3 other kinds of buildings, maybe even more. No work. I'm going to tell you how to refer me to your clients to make it very, very easy for you, and I'll do all of the work. The CARES Act, which we've all kind of benefited from recently, I think, has changed a couple of things as far as cost segregation goes, and it makes it an even bigger no-brainer these days than it ever was before, because they've given us a 5-year carryback of net operating losses arising in 2018, 2019, and 2020. It's a stimulus. It helps by being able to carry them back and roll forward if the loss is in excess of the carryback year's income. But take a look at this. John Smith has income for the past 5 years, and we did a cost segregation study for him in, say, 2019. It generated $425,000 loss to his business because of all the additional depreciation expense that he was able to take off of his taxes all the first year. Well, it created the $425,000 loss, which he's then now, because of the CARES Act, able to go back and look at his profit in 2014, which he paid $14,606 in taxes. He can apply some of that loss to that and get a refund of all of the taxes paid in 2014, 2015, and in his case, a portion of 2016 back without having to refile his taxes. So not only does he not have to pay the tax in this year, he can file for $115,000, almost $116,000 of refund in that year. How many people would not want to be able to do that? And it helps make cost segregation a no-brainer for property owners in 2020. They've also changed how qualified improvement property is handled. Basically, they fixed congressional oversight back in 2017 in the Tax Cuts and Jobs Act. They now define qualified improvement property as 15-year depreciable property, which means that if it was acquired and placed in service after September 27th of 2017, it's eligible for 100% bonus depreciation in that first year. And you can go back and retroactively apply that bonus depreciation for any qualified improvement property, and it increases your loss to offset your gains that could either reduce your taxes now or create an opportunity for a refund now if it's sizable enough. They also suspended the net business loss limitation. And I know this is tax stuff, but I want you to be able to see how big of a no-brainer it is now because of the CARES Act. Individuals and owners of a trade or business that generate a net business loss to offset income from other sources used to be capped at $250,000 for a person filing single and $500,000 for a person filing jointly. They have removed that cap for 2018, 2019, and 2020. So individuals who had individual taxpayers who had a net business loss in excess of those deductions, the caps in 2018, can amend their taxes and capture that benefit and get a refund. So cost segregation, accelerating depreciation on real property, personal property, as opposed to real property, is kind of the foundation for the loss carrybacks of the CARES Act, the QIP changes in the CARES Act, the Tax Cuts and Jobs Act, and the Tangible Property Regulations of 2014, which we'll talk about. Because without a cost segregation study, there are some changes that need to be made to their depreciation, and they may not even be aware of it. And not even all CPAs are aware of it as well. I spend a lot of time teaching CPAs on cost segregation and those kinds of things. In fact, I was happy to be a speaker this year at the Georgia Society of CPAs Real Estate Conference, talking about this very thing and also talking about the real estate professional designation for the IRS and helping them kind of decode that a little bit. So, okay, what is cost segregation? Cost segregation is a U.S. tax code approved process of analyzing and identifying commercial building components that are eligible to be depreciated quicker than the 39 years that the building is depreciated. The standard way of looking at things is when somebody buys or builds a building, the building and all of its pieces and parts are depreciated at 39 years straight line because that's the easy way to do it. Well, the tax code says there are better other ways of doing it, including engineering-based cost segregation. It's an input calculation to the U.S. tax code, and it allows building owners to use their cash today instead of leaving it with the government for 39 years. In a cost segregation study, we break the building into all of its component pieces and parts, and we segregate the personal property, which is really everything non-structural in the building, from the real property. The tax code calls the engineering-based method as the certain method. And all of that personal property that's segregated out is then eligible for quicker depreciation than 39 years. Normally it's 5, 7, and 15 years. However, because of the 2017 Tax Cuts and Jobs Act, we've been given 100% bonus depreciation for a while, which means all of that short life property, which includes the qualified improvement property as well, can be depreciated 100% in the first year. 100% in the first year. So basically, it's going to help you depreciate $30,000 to $80,000 per 1 million in building cost over 5 years. And we can do it for buildings or tenant improvements as small as $200,000 in cost. Here's what can be accelerated. Your 5 and 7 year property can be your interior doors, your movable wall partitions, your decorative elements, wall coverings, electrical, plumbing, mechanical, carpet, flooring, decorative molding, built-in cabinets, countertops, all of those kinds of things, kitchen fixtures, refrigeration equipment, all of which, if you segregate them out, And the cost for each of those out can be depreciated right now 100% in the first year. Your 15-year property is going to be your landscaping, your property improvements, paving, fencing, site utilities, parking lots, signage, sidewalks, irrigation. All of that helps you take all of that depreciation right away rather than waiting 39 years. But it can't be done without a cost segregation study. So here's what it looks like, separating the 1245 property from the 1250 property. That's the real property, the personal property from the real property. A cost segregation study will take all of these building components and separate them out into 5, 7, and 15-year properties so that they can be depreciated quicker. They're all enumerated there. It's done by a group of engineers. So give you an example of how it works. Dental office. The building cost without the land cost $250,176. The tax savings benefit from segregating those out and getting the depreciation quicker, $32,845. That's additional depreciation generated by a cost segregation study. The study cost the dental office owner $2,420 before tax, but it's tax deductible as well. And so after tax, the study fee was $1,549, and that's a return on investment of 21 to 1. An office condo, same idea. Building cost was $324,000. The tax savings benefit on the condo was $52,856. The study cost the owner $3,400 before tax, $2,176 after tax, 24 to 1 return on investment. There are not a whole lot of other places where you can get a return on investment like that. An office warehouse, this is a $5.25 million piece of property building. Tax savings benefit was $312,687, got a 33 to 1 return on investment on it. So there we go. Sorry. My screen just went all funny. Okay. One other thing that CSSI does, and there are a lot of companies that can do cost segregation out there. There are some very specific reasons why I'm going to suggest you work with me and work with CSSI. But we provide building systems analysis to their CPAs because in the future, when they do repairs, when they do replacements of some of the systems, they're going to need to make calculations to determine whether they need to expense it or capitalize it. The only way to do that is to know the building system cost. And a lot of the companies that do cost segregation studies either do not do the building system calculations or they charge extra for it. We don't think that that's right, and we include it with every study. The tangible property regulations, I'm just going to mention these because you're not CPAs, don't desire to be, I take it. The 2014 tangible property regulations were put into the tax code again in 2014, and it redid the way that improvements or repairs are looked at and items, how they calculate whether they capitalize the item and have to carry it on the depreciation schedule or expense it. There's a consistent method, but they have to know the building system valuations in order to do it. And there's some serious compliance issues and some rather huge tax savings available for building owners. We will compare everything to the 2014 tangible property regulations, make sure they are 100% in compliance, as well as get them the tax savings that they deserve from making some changes because of the 2014 TPRs. They have also given us the ability, and most people don't know this, to write off any assets no longer in use. It's cash from your trash. Any renovations or remodels or replacements, anything that's abandoned in place, any LED retrofits, partial asset dispositions basically can get you tax deductions for everything that goes into the dumpster when you do a renovation on a piece of property. These are lessees as well as owners. They have to be taken in the same year as the renovation is done, and you don't have to capitalize the removal costs either. If the partial asset disposition is employed, you can actually write off the removal costs as well. We'll calculate all that out for them, make sure that they get every dollar that they're entitled to. So, give you a prime example of how this comes into play, the 2014 repair regulations with an auto dealership. You know, if you've ever dealt with auto dealerships, that they're constantly required by the company to renovate their showrooms. And so they have to tear stuff out, they have to put new stuff in, they have to make some serious changes. Here's an auto dealership that we dealt with. The original building, by doing a cost segregation study on just the building, we generated them an additional cash flow of $134,718. But there was money hidden in the dumpster. The demolition got them an additional tax savings of $53,297, and the renovation applied another $126,243 in tax savings. We got them a total tax savings of $314,240, where if they had just done a cost segregation study and not taken the renovations or demolition into account, they would have missed out on a significant part of that money. I'm going to skip over this. I think you get the idea. The repair regulations are great for compliance. Our studies are great for compliance with the 2014 repair regulations, as well as the tax advantages that are given. Talk a little bit about the 2017 Tax Cuts and Jobs Act. Like I said, they gave us bonus depreciation, which means all the 5, 7, and 15-year property can be depreciated 100% in the first year. We mentioned the CARES Act change. This has to do with new purchase, new construction, addition, or renovation. The assets have to have a depreciable life of less than 20 years. So we identify all of those and provide them with a cost savings of $30,000 to $80,000 per million of building value in the first year after the Tax Cuts and Jobs Act. Here's an example of a self-storage facility that we did, an $8 million facility. If they had not done a cost segregation study, they would have had a depreciation expense on the building of $26,000 in the first year of ownership. Because of a cost segregation study, we were able to accelerate that up to $154,000. But because of bonus depreciation, their additional deductions the first year became $700,000 because of all of that short life property being able to be taken in the first year. And you know, if you use that money, it's going to grow. And so we believe in the time value of money. And so not only is that the benefit, but the future value of all that money that you're getting now. Well, if I was going to give you $1 million, and I'm not, so don't get excited. If I was going to give you $1 million, would you prefer that I gave it to you right now, or that I gave it to you 1/39th each year over the next 39 years? If you said you'd rather have it over 39 years, you can leave this webinar right now. You don't understand the present value of money. If you said you would have it today, then you get it. For clients who purchased property prior to the 2017 Tax Cuts and Jobs Act versus after, here's the difference. Here's a funeral home. Total property cost, a little over $500,000. First year tax flow from an accelerated depreciation is almost $20,000, with bonus depreciation over $37,000. And you can see all the rest. A hotel obviously costs more, it's the bigger benefit, but instead of $692,000 in deductions the first year, they got $973,836 in deductions the very first year. So it's a good thing. Here's a case study. We helped a restaurant owner during the 2008 bust in the economy. If you remember that, September of 2008, successful restaurant owner had a grand opening on his second location. It was a great day. And just about that time, just like during the COVID season, when it was ready to open, the economy tanked. Nobody was eating out. The restaurants were struggling. The client owed $70,000 in taxes from a successful prior year. We completed the cost segregation study and freed up the $70,000 that the client needed. And got a call a few months later from the client and said, because of our cost segregation study, They were able to stay afloat during that time and keep their employees. If they'd had to pay those taxes, she didn't know if they'd have been able to stay in business. It's a great opportunity to free up cash flow to stay in business or to improve your business during this difficult time. So here's your job. I give you two different scenarios, but if you're talking to either someone who recently bought a building or someone who's looking at a building, you can say, Charles, we've partnered, unless his name's not Charles, whatever his name is, we've partnered with a firm specializing in tax savings throughout the U.S. and through the U.S. tax code on commercial buildings. The end result is a $30,000 to $100,000 or more income tax savings in the first year for the partners who own a building. The process works especially well for those buying or building a commercial property. This is a very common tax savings method for building owners and their CPAs. Based on what I know about your history, I believe they may be able to impact your cash flow immediately. May we create a no-cost pre-analysis for you? Then if they say yes, all you have to do is call me. I'll get a few bits of information on the building and we can run the free analysis and provide it for them. Or if you prefer, you can say, hey, I have a partner that may be able to save you money on your income taxes. Do you mind if I conference one of their reps in on a discussion? They really know their stuff. If you're comfortable with us sharing some information with them, it could be very beneficial for you. That's all you need to do. I'll take it from there. And when we do the study, I will provide you 10% of the study fee. Now that may vary depending on the size and the value of the building, but they do add up. So the best way to get started, I can provide them with a no-cost predictive analysis. I can provide you with a no-cost predictive analysis on any property perhaps you have listed. What I need for those buildings is if they purchased it a number of years ago, then their depreciation schedule would be great. But really all I need to know on the building is the type of building, office building, medical building, warehouse, whatever, the cost basis. That's the cost of the building, not including the land. If you don't know that, that's fine. We can calculate that. Just I need to know when you give me the figure whether or not it includes land. The year and the month they acquired it or built it, and any improvements that they've made since they purchased it or built it, year, month, and cost. Since we're dealing mostly with newly acquired buildings, there probably won't be any improvements unless they're buying an old building and doing improvements before they move in, and we can add that all in. We'll generate an analysis at no cost within 48 hours that will specify the cost of the study and also give them the estimated tax benefit. I can tell you, it says it will be within 10% of the actual cost segregation result. Unfortunately, that's not always true. I just had one that was, when we did the estimate against the actual study, there was 50% more tax savings on the actual study than there was on the estimate. They like to promise low, deliver high, because it makes us look good, it makes you look good. And basically all I'm going to ask them is, if you like what you see, is there any reason you wouldn't move forward with this? We'll also talk with their CPA. A lot of people may say, well, yeah, that's fine. My CPA's already done this, or my CPA handles all of that stuff. That's fine. I get it. But most CPAs only can take that low-hanging fruit. They're not engineers. So they can only itemize the things that are easily identified and move them into the shorter life category. A cost segregation firm, especially one that does engineering-based cost segregation, is required to take all the accelerated depreciation that the current tax law will allow. So our experts will look at the depreciation schedule or the building and give a very good idea of what may still be available, even if the CPA's already done it. We've got a little comparison here. This is in general. I don't believe this is a specific study, but the potential CPA method, they were able to identify some of the short life property. We were able to identify a lot more of the short life property. And in the end, the engineering-based cost segregation study saved them over $42,000 in taxes. That's significant. And so we work directly with their CPA, but most CPAs recognize they don't have the time or ability to do a full cost segregation study. and they work with companies like ours in order to do it instead. So I partner with a lot of CPAs. I partner with a lot of commercial real estate brokers. We do them a little bit differently because CPAs generally are referring me to their clients that have just bought a building. Commercial real estate people know a lot of people. And so they may say, yeah, that's fine, but I don't want to trigger an audit. Well, CSSI has been around for a long time. We've completed now more than 23,000 studies nationwide. We're the largest and the premier cost segregation study company in the country. We have never, and I emphasize never, we have never triggered an audit. In about a dozen cases in which the building owner was audited for other reasons, we've been willing at no extra cost to send one of our engineers out from our headquarters in Baton Rouge, Louisiana, to defend the study. And in every single case that's happened over the last 18 years, we've seen a favorable result in the situations. We will always stand behind our numbers. We'll defend them at no additional cost to our clients. Other cost segregation companies, if they need to travel, if they need to do audit protection, they do charge extra, and that's just not right. Listen to the experts. Many of you know Dave Ramsey. Dave Ramsey says cost segregation is a proven tax strategy. Even the Journal of Accountancy says the technique is no more aggressive than using any permissible depreciation method. It is the recommended method of doing depreciation. So why CSSI? Who's CSSI? Well, like I say, we're the premier engineering-based cost segregation firm in the United States. That number's wrong. Disregard that. We've been doing it for longer than 16 years. We've completed over 23,000 studies now. Cost segregation came into the forefront back in 1997 when Hospital Corporation of America sued the IRS because the IRS was after them for back taxes. They claimed because of this item in the tax code called cost segregation that they didn't owe any taxes, but the IRS wouldn't let up. Go figure. So the IRS got sued by Hospital Corporation of America, and they went into court. And so Hospital Corporation of America hired an engineer by the name of Jim Shreve. He was tasked with the task of creating a full cost segregation study. He did that, and ever since then, he's been doing it as the CEO of Cost Segregation Services. His goal was to make cost segregation available to small and medium-sized building owners rather than just the Fortune 100 companies that could afford them before. And he's been successful in doing that, as we will take buildings from $200,000 up. And in most cases, it's going to be a good idea to do a cost segregation study, but our preliminary analysis will let us know that. We complete our studies in 6 to 8 weeks, including the disposition expense, the cost segregation, any capital to expense reversals. We take advantage of the Tax Cuts and Jobs Act opportunities. We can handle the benefits of LED lighting if that's done, the low energy lighting. We can also do an analysis of R&D tax credits if necessary. We will defend our study in the event of an audit at no cost to our clients. We are the calculation resource to help your clients become compliant with all of these tax codes regarding depreciation. So how it works, you introduce your client to me. I can meet with your client, or I can simply talk to your client, or I can work everything through you and never talk to your client. We're going to gather the information, the few pieces of information that we need to gather to do the preliminary analysis. And if they say, this sounds great, then I like to personally, when I send them the preliminary analysis, I like to go over it with them and their CPA. So their CPA feels involved and can tell them if there are any particular reasons why he or she doesn't think that it's a good idea for them to do a cost segregation study at this time. Maybe there's something going on we don't know about, but that's okay. If they decide with their tax professional that cost segregation is the right decision for them, we will collect then a 50% retainer for the project, and we begin our process. We work with the client to gather documents and support, appraisals, blueprints, closing documents, those kinds of things, so that we can be totally accurate in what we do. We also come out and take pictures of the property and survey the property so that we have a full photo narrative for our engineering analysts. 6 to 8 weeks after all the data has been collected, the final study will be available to your client and CPA. If the building is older than a year and has been on a depreciation schedule already, the CPA is required to file a change of accounting procedures, which is the IRS 3115 form. It is, from what I've been told, I've never filled one out myself, but I've been told it is a major pain in the rear. So CSSI will also create the 3115 form for the CPA if the CPA wants us to do that. And that's just part of our service, and we're pleased to be able to do that. That's another thing that a lot of the other companies charge extra for. So that's it. All you do is introduce them to me. If you're interested in becoming a referral partner with me, I have some paperwork that'll put it all down in writing if you like. If you have any questions, I'm going to take those now. If you'll put them into the chat box, and we're going to be able to end ourselves early today. I must have talked really fast. Let me know if there are any questions. And if you can find your chat box. If not, I either did a really, really good job or I have bored you to tears. Here is my email address and my 2 websites for my company and for my webpage at CSSI.com. I would love to talk to all of you about partnering up, seeing if we can help your clients. If you have buildings that you have listed for sale, I am more than happy to run a preliminary analysis based on the asking price of the building, so that when somebody comes in and asks about the building, you can say, by the way, we can send you to someone who can help you save this kind of money on your taxes. And you can show them in writing what the tax savings would be and what the cost would be. So get those in hand so that when you're showing a building to someone, you can provide them with that information as well. Makes you very sticky and makes you look really, really good to your potential client. Thanks, Alan. Yes, we can do cost segregation on rental residential property just as well. It's all the same, except it's 27 and a half years normal depreciation instead of 39. Where they came up with 39 and 27 and a half, I have absolutely no idea. For those that own rental residential property, I also offer myself for some ongoing consulting if they like. Each year when they need to do all the regular maintenance that they have to do, replace carpet, paint, parking lot striping, that sort of thing, I can help them get those under the IRS safe harbors so that they don't have to expense those. It cannot be done on a primary residence. It must be on rental residential property or commercial property. Now, I do have one that I've done where someone owned a large home and rented out one floor of it. The one floor was worth almost $1 million. And we were able to do a cost segregation study on just that floor that they were renting out. And it wound up getting them some pretty significant tax deductions. So yeah, it can be done on residential property, not generally on primary residence, but on rental property, investment property, commercial property, that sort of thing. Hope that was clear. Anybody else? My pleasure, Alan. Good to talk to you again. I look forward to talking to you again. I will look forward to the form for your 4 properties. Anybody else? If not, please take down my contact information. I will also be willing, if you want, shoot me an email. I'll be willing to send you the slides that we went through today. And the recorded webinar will also be available. Please share it with other commercial real estate folks. I think this could help them out, especially somebody who is fairly new in commercial real estate, needs some way to distinguish themselves and make themselves attractive to potential clients. this could be a great way for them to do it. Look forward to talking to you. Look forward to working with you. Thank you so much for joining me on the webinar. You will definitely hear if I have any more webinars directed for my commercial real estate friends. And in the meantime, I will say thanks so much. Have a great day.